Thanks for joining us for our fourth quarter investment update. I'm John LaBarca, Director of Investments at Vision Capital. We've seen slowing in the job market in 2024 in response to slowing real demand with consumer budgets under pressure. Both jobs added and job openings have fallen this year. The economy is now back to a much more balanced 1.1 job openings per unemployed worker, down from over 2 openings back in 2022. We've seen reported jobs data consistently revised lower in subsequent months, which often happens when the job market cools. These patterns, along with the sluggish number of full-time job additions, are all consistent with what we've witnessed before the most recent few recessions in the US. The unemployment rate has also risen in 2024 and is up 0.7% from last year's low. There's an economic rule of thumb that says when the 3-month average of this rate increases by more than 0.5%, the economy is entering recession. It doesn't have to be the case, but it's been highly accurate every time it's occurred over the last 50 years. The trends I just covered are why the Federal Reserve has now begun to lower interest rates in an attempt to stave off job losses, which we have not yet seen. So let's review how markets have responded. While we saw some brief instances of volatility around economic reports, the third quarter was another strong quarter for markets as investors celebrated the Fed's rate cuts and lower interest rates. The S&P 500 gained 6%, and we just enjoyed the strongest 9-month start to a year since 1997. We've been talking about the attractiveness of smaller company stocks for a few quarters now, and we began to see some improved performance in the third quarter as the small cap index gained 10%. Bonds also did well, putting in one of their strongest quarters in decades, gaining 5%. Even after the improved performance in Q3, we still see opportunities in small cap stocks that continue to be valued at significant discounts to large cap stocks. This chart shows that the small cap index is still the cheapest it's been relative to the large cap index in many years. We believe this can get back to a more normal relationship in a soft landing scenario. We still see 2 paths for the economy. Either a soft landing, the probability of this has fallen this summer due to the soft employment trends, or a recession, which is a lower probability but an increasing risk despite the Fed lowering rates. Just as the economic impact of Fed policy had a long lag on the way up, the economy could experience long lags on the way down as well. The key will be how job trends develop over the coming months. Larger stocks are very much priced for the soft landing outcome. We recently decreased holdings in large cap stocks given the increasing risks coupled with their historically high valuations. With the upcoming election, we continue to get many questions from clients. While one of the candidates has changed since our last update, our message remains the same. Asset returns have not seen much lasting impact from political outcomes. This year has been another good example of this. While many clients are worried about the upcoming election, the market just had one of its strongest 9-month starts to an election year ever. Staying invested is what's most important to one's long-term financial plan. Thank you for joining us for our investment update, and we'll see you again in early 2025.